first time at a workshop this going?
I came to one maybe in like 2002. It was been a very long time.
Do you have a mentor already or
No,
are you starting
but-
your relationship with them?
I don't, but I recently saw that that's now part of the services that you guys offer.
Yes.
So
What is your business or what is it that you do?
I own a wellness
Oh.
studio.
Okay,
Yeah.
very good. Very
I
good.
actually had a question about that though, because there's different like areas I feel like they could use mentoring in. So can you work with multiple
Yes.
mentors?
Yes, what you need to do is go to the webpage and click on find a mentor.
Yeah.
In your area, you put your zip code and you're gonna be matched with someone.
What you might want to do, Donna, just
Yeah.
if you drop this down, then you can put it in your pocket and just clip that on your. sweater.
They will be like speak to someone else or bring someone else. that knows someone. So it's great that you're in and make the most of it. Almost everything is free or not.
Yeah, I did. I spent some time going through it.
I was like, where is your business?
Del Monte, if you come up from Sunset Cliffs, it stops in about 2 blocks because it gets too steep.
Yeah.
And then it starts again.
Yeah.
And we lived on the block that it started again.
Yeah, so at that overlook. I
Yeah.
lived in OB area for 17 years, so I'm very familiar with what you're talking about.
I love OB. I live over right across the street from, let's see now. Right across the street, or, excuse me, right across the canyon from the University of San Diego. Yeah, my first wife passed away and I was in that big house by myself for quite a while. So I'm just rattling around in there, you know. I love the area. Sometimes regret selling it. But the night, what we have now is really nice. So. And
Microphone cover.
so I could- having trouble
You
here.
need help?
I need a lot of help. If you don't mind, we stick it on here somewhere.
And then you want, why don't you put it there?
Yes, yes.
And then hang on, you lost the microphone cover.
Oh, the
Keep it from being.
hiss. Go right there.
Exactly. See if that'll
Okay.
work for you. Is that okay? I put it on the blue one.
Do you have a mentor?
I put it on-
Oh, no, that's fine. Yeah, sure. Okay, well, it's 5 after, I tell you what. Really? How about that? Jay Boyer. How about that? Okay. So it's 5 after. We'll go ahead and get started. I don't like to chastise people who make it on time. Other people won't. So we'll go ahead and get started. I was how to put this. This is the first time for me that this is going to be done as a hybrid workshop, meaning online and in person. So it is my intention to pretty much ignore the online part because we won't be able to hear them. So, and we won't be able to see them. And so we'll just ignore. They're not here. Okay, so if you're online, sorry about that. Okay, so let's get started. Everybody in the right workshop? That's important. Okay, now let's see if this is going to work. Oh, crap. It just worked and it won't work anymore. Huh. Well, that's try one other thing here. There we go. Okay. Okay, we'll just do introductions first. What we want to do is like get accustomed to being able to do this quickly. I've had people that I just say in general, give me an introduction, and about 15 minutes later they stop talking because I tell them to. So we want to have what's called an elevator speech, and you all know what that is, right? You get on an elevator and Jeff Bezos is on there, richest guy in the world now. Is he or Musk? One of the, it doesn't matter. And he says, what do you do? And you got 10 stories to tell him, not 30 stories, 10 stories. Okay, so 30 seconds or less. This is what we just want to get used to. Name what your business name is. What are you offering? What is your product or your services? And what's your current stage? Okay, you want to start?
Sure.
That's what you get for sitting up front.
Sure. I'm Katie. My current business is Parts Wellness Studio, but I'm just in the planning stages of maybe having something separate. So I'm coming to this workshop for 2 reasons. My current business, I do injury prevention care, rehab, holistic health, those types of things. And I've been in private practice in this location for 15 years. So that one is kind of flowing. My new one is I'm looking at doing maybe some sales and e-commerce, and for both businesses, I really like to just get some tips and tricks for.
Okay, good. All right, Florence?
My name is Florence Trent. The name of my business is DM Services. What I offer is workshops and one-on-one counseling after that. My workshops are mainly about your interior. I talk about self-esteem, loving yourself, and that type of thing. And I'm here to relaunch it. I actually started it back in 1990, and working full time, the mom and everything else, back and forth. I do some, but now that I'm fully retired from 8 to 5, retired 8 to 5, I'm relaunching, and I need.
Okay. Okay, Ashley?
Ashley.
Pediatric, what kind of service? Occupational therapy for pediatrics?
It's not a job.
Is this like child labor? I understand. No, I'm just kidding you. Oh, yeah. We just don't have enough words, do we, Liliana?
Hello, everyone. I'm Liliana. I'm a marketing consultant, and I'm a sport volunteer. And I'm here to learn also, not only how to do financial planning, but how to do workshops on the sport style. Because
Okay.
I'm planning to do a couple of them myself in a couple of months, I guess.
Okay, my name is John Huam. I'm a retired engineer. I was a member of a startup with 3 of us. There were 3 of us, 2 other guys, and I started a software business. We did Salesforce automation software. And then we sold the business and I retired, and I've been a SCORE volunteer. This is starting my 8th year in SCORE. Okay. So let's go ahead. Here's what I want to talk about today. We talk about financial projections, strangely enough, because that's the name. But first, what's it for? What are you going to use it for? Understand the difference between financial projection and accounting. They're related, but not the same. What the major components are, and then we'll try to show you how to make one. Businesses are so diverse that there is not a way to do it. So I've got an example, and I tried to get an example that had a little bit of everything. but we can't do it for like years and years and years because we'd have to do 3 of them and it would be awful. So, okay. We're going to use a fictitious company as an example, and I'll show you that. Okay, our guiding principle for today is Einstein's dictum. Have you heard this before? Keep things as simple as possible, but no simpler. There's some degree of detail that we must go into or it's meaningless, right? So we'll try to stop there. That's the thing about, one thing about financial projection versus accounting is that you only go deep as you need to go. Accountants will go to the last penny. They'll stay up all night because 1 cent isn't balancing. You know, we won't do that. Okay, and again, if you just kind of look at this list, these are so different that it is impossible, of course, to have one. So if you go online and say, this is a universal financial projection, use it, click the exit button, so go somewhere else. There is no such thing, right? The general methodology is pretty much the same. And there are some specifics that are, but I want to warn you, even the vocabulary is not global. I've used, the vocabulary I'm using here is very common, but it's not universal. You'll hear things called different things. I'll try to give you some synonyms as we go through so you'll know what they are. But just be aware, you're going to say, well, you know, John didn't have gross profit on his. Well, I don't use gross profit, I use something else. So, okay, so start off with financial planning versus accounting. The financial planning is really based on 3 major documents. The first one is called the P&L, profit and loss, and it's just pretty much what that says as a function of time, usually monthly and usually 1 or 2 years. Depends on your what's called a sales cycle, how long you need to go out. If you got a short sales cycle, then a year is plenty. Your sales cycle defined as the difference between the first time you engage a customer and the first time you get money from them. That's a sales cycle. Okay, but if you're selling large, complicated, like our sales cycle was pretty long because the software that we sold impacted the company quite a bit. There was a big decision for them. So we go, you know, 9 to 12 months sometimes. Right? So we went out 2 years because of that. So you want to go either a year or a couple of sales cycles when together. It's formal and it's usually done by an accounting system. QuickBooks is the 900-pound canary in that space for small business. And my advice is always, if you don't have a system picked out yet, pick QuickBooks because everybody uses it. Reason being, my grandmother doesn't own QuickBooks, but there's a lot of people that know how to use it. So if you have, you want to get a bookkeeper, it's easy to get one. And if that bookkeeper gets run over by a truck, it's easy to replace it. Okay. So just, if there's a standard in your industry, use it. Don't fight it. There's plenty of other windmills to tilt. Point is, it's historic, very detailed and accurate. Those are sort of the takeaways. Projection is informal. It does what's called an estimated profit and loss. In other words, we'll go into this ad nauseum here pretty soon. And the cash flow is incorporated. Whereas in financial statements, you'll get a formal cash flow statement from your bookkeeper or your accountant. It's incorporated in the P&L, and you'll see why. Oh, wait a minute, I forgot to tell you something. If at the end of this, we're going to hand out some evaluation sheets. And if you give me a high enough evaluation, I will send you a copy of all these. You won't have to. So you don't have to take, I mean, you can if you want to, but yeah. So I forgot about that, sorry. Right. So the balance sheet, which a balance sheet says for this point in time, the moment that balance sheet was closed, was developed, what your company is worth, assets and liabilities, and they have to match. That's rarely done in a financial projection. There's two generic kinds of companies. They're called lifestyle and scalable. And a lifestyle company is what I think most of y'all have. And that is a company that you run, you're going to run it for the rest of your life, give it to your grandmother or grandson or daughter or whatever, and retire, right? Or maybe sell it for a little bit, but you look at it as your primary source of income, right? And that's how you run it. A scalable business, on the other hand, is one that people are building up to sell. And they really don't care about how much they make. They want to build their worth. And so hence a balance sheet is very important to them. So they might run a balance sheet, but unless you have a scalable business, you're going to sell it off, go to Tech Coast Angels or a VC firm or something, and Jeff Bezos or somebody sell it to them. You probably won't want to do that. The format here is formal. There is an accounting standard. Actually, I'll show you in a minute, there's actually two standards, but they are standard. In a financial projection, you do it the way will best help you out. Okay. Normally we do this on spreadsheets. I like Google Drive, although the one I'm going to show you today is in Excel, but they're exchangeable. I just did it in Excel because it's easier to put it on this thing. So Google Sheets is great. It's free and works. Yeah. Problem is, I'm sorry, the point is it's speculative. Obviously, you're predicting the future. Yogi Berra said, predictions are hard, especially about the future. It's high level. It's just as you only go as low as you need to, and it's just your best estimate, your best guess. Okay. These should use, however, what I think called a chart of accounts. And all that is bookkeeper speak for those elements that you keep track of, like rent would be in the chart of accounts, or, internet connection would be in the chart of account. It's what they keep track of. And they should more or less track one another. Okay, there are two methods of accounting, as I was alluding to there. One is the cash basis. And in cash basis, you report income when you receive it, and you report an expense when you pay it. Hence, cash basis. It's just like if you were running an old-time hardware store, or when somebody comes in and buys a hammer from me, you give them a hammer, they give you money. And then when you buy a stock of hammers, the hammer salesman comes in and gives you a dozen hammers and you give him money, right? Cash basis, just exactly like that. The other one is called accrual. And an accrual basis, you report the income when it is, quote, earned. And what they mean by that is if you write an invoice, if you're in an invoice type company, you may not get paid for 3 months, but you take it to the books. In other words, you report it, record it on your system when you send out the invoice. You haven't gotten the money yet, may not get it for a long time, or may not get it ever for that matter. But expenses is the same way. You expense it when you write the purchase order, not when you write the check. Small businesses hardly ever use that. There are some that kind of have to, but I don't see one in here. Just FYI, when you get rich and famous, I think it's $25 million threshold, the IRS will start yelling at you to do accrual because they got some reasons they want to do, large businesses to do that. But until you get to 25 million, you don't have to worry about it too much. Okay, obviously most people do use a cash basis, but you want to make sure that you keep track of all this stuff, the inventory, the invoices, if you do invoice, unpaid obligations, stuff like that, they would be items in an accrual system. You don't put that in cash system, but you want to keep track of them so you know like how much you got in inventory, stuff like that. The projection and the counting, again, should use the same method. We're going to use cash. So this will be on the cash basis. Okay. Yes, ma'am.
So this is like mine with inventory, where I'm not trying to sell it, but a tangible item. So my inventory would be like my computer, the things that I use to
Those are assets.
Okay.
Inventory is what you sell. Inventory are goods that are going to be sold or used. Maybe if you use things like towels and consumables, that would be inventory.
And then for senior kids, wouldn't it be like the hours that you're able to provide the service? That's your inventory. You can only sell as many hours as you can.
Yeah, that's assets. Those are the assets. Yeah, those are assets.
Okay.
Yeah, so their inventory, the word inventory is taken to mean usually goods that are there for resale, for shipping. Now, a lot of service companies will put their staff on as inventory, hours inventory. So they'll say they talk about a metric of hours sold or time sold. Okay, and so they'll say, okay, we got 2,400 hours we can sell per month. So that's our quote inventory, our services inventory. That's getting down in the weeds a little bit, but it makes sense if you think about it. But you shouldn't have to worry about that too much, these kind of businesses you've got. But no, inventory means what you're going to sell. Now, you want to keep track of your assets. And some people will use the same term, inventory, for both of them, and then it gets mixed up, and that's bad. So, okay. Okay, well, why do it? Didn't have anything else to do today? I should come in here. Why not, right? Okay, first, the most important of all is, can I achieve my goal? I think that's the most important, whether it's a startup or if you're expanding a business or running a business for that matter. Okay. Can I meet my goal? You should always have a goal in terms of time and money. That means, let's say you're a startup and I'll say, okay, I want to, my goal is to be having earnings, that is bottom line, that I could take home if I wanted to, earnings of $5,000 a month within a year. That's a goal, right? Hard goal. So the same thing for you. If you're already in business, you say, okay, well, a year from now, I want to be doing X. And that is your goal. But if you don't have a goal, what are you doing this for? It's also good for what ifs. So you might say, well, I could bring on a therapist or whatever okay, an employee. What if I did that? You can go in and run your financial projection with and without and see whether financially it makes sense. Okay. That's done a lot. And then you always want to check progress against your plan. In our business, we had every month what we call a financial and operating meeting, F&O. We hated it. We despised it, but we did it every week. And what we did, there were three of us. One was his title was president. He did admin and finance. There was a guy that did marketing and sales, and I did operations. I was chief engineer. I had the fun job. So we get together and we say, okay, what did we say we're going to do last month? We had a 1 year projection that we did this on. What did we say we're going to do last month? What did we really do? And just work it out if there was any significant differences. Then we'd reset the projection going forward. Example might be this happened all the time. The marketing guy would say, hey, I heard about a new trade show and I want to go. It's about 8 months from now. It's going to cost me $7,000 to go. And I need an engineer for 3 weeks to get ready for it. And then we'd hash it out. So we'd have to go in there and put $7,000 in there. And I'd have to figure out how to, So we did that a lot, checking the progress against the plan, and then resetting for the next month. That's the way we ran our business. There may be some other stuff you can do with it. I have no idea. But once you got a projection, you'll find all kinds of weird stuff to do. You can do data mining, if you want to see if you got a lot of different offerings, what's really making money, what isn't, stuff like that. Okay, typically we do these on spreadsheets. That's a picture of it. It's Google Sheets. It is not as powerful as Excel, but it'll do everything you need to do for a financial projection and more. It's free. One of the really good things about it is it's portable. If you can get to a web, you can get to your Google account. And it's make it very easy to share. I use it a lot with clients because I know that what they've asked me to look at is the latest version. Back in the old days when we had to email Excel files back and forth to each other, I never was quite sure that I had the same one they were talking about. But here, when you go on, if you share with me your sheet in your file, your Google Sheet file, that I know I'm seeing the last one. I absolutely know I am. And you know I am. And if the two of us are on the same time and you change something, I can see you change it. And vice versa. If you put me in as an editor, it's the other thing, you can put the reviewer in as view only, edit, and do anything. Okay. So be careful. So I recommend that. It's very, and like I say, it's free, so that's good. All right, what are the major categories in a projection? Take the very most simplified, the top line will always be cash on hand. And that doesn't matter what type of, whether you use an accrual or cash. It means the total cash available at the start of the month, not the end of the month, the start of the month. Then the next one down is usually revenue. And that, again, we're talking about cash accounting now. So that's cash received during the month. Okay. In other words, this would be the total amount if you were looking at January, and the number for revenue in there would be the total amount of revenue you expected to receive during the month of January. Costs are all projected expenditures during the month. Again, it's all during that month. One little vocabulary thing here. When we talk about cost, that means what you have to pay. When we talk about price, that means what your customer pays. Okay. Earnings is simply revenue minus costs. Earnings is the bottom line. That's what you could, if there's any there, that's what you could take home. That's sometimes called EBITDA, E-B-I-T-A, and it stands for earnings before interest, taxes, and accrual. It's just a B-school buzzword because they like to think that they're erudite, but it is the bottom line. You say somebody tells you what's the bottom line, it's earnings. Okay.
What was the acronym?
EBITDA. They always try to pronounce the acronyms, of course, EBITDA. If it's earnings before interest, taxes, and accrual. Now, accrual is a accrual accounting term. So don't let that confuse you. That's just a term that's used. People use that term even though they're doing a cash accounting. Yeah.
Would you say it one more time?
Earnings before interest, taxes, and accrual. EBITDA. So you can, while you're friends, you can say, well, my EBITDA this month was, say, whoa, Catherine, that's what she's doing. Okay. These will become these are top row, top level. These are the top level headings in the spreadsheet. Okay. This is pretty simple, but it could work for a small business. If you're a one-person consultancy, it just might work. Let's take a look. So here's got a one-person accounting business. Okay, has no employees, just does accounting. Pretty typical for a bookkeeper, by the way. Okay, so here's the way she would do her projection. Top level is cash on hand. Now, a couple of things. One of them, I just revised this this last week. So if you find a mistake in here or a misspelled word or something, please bring it to my attention. I tried to QA it, but I'm not very good at QA myself. So there may be some misspelled words and stuff. Okay. Normally, though, what we do is if this is a white cell, that means that the system puts it in for you, or you put it in. If it's the colored, it means the system figures it out. Okay. So obviously the cash on hand, we're assuming she's just starting here. So the first month she had to put it in, right? It'll calculate it from then on out. She has a line for revenue, a line for total costs. It's everything she did during that month. And then the earnings are simply revenue minus cost. Okay. And there we go. Uh-oh, but there's no money for the owner. So she forgot something. What do we do? All right. So what we do is we put in a thing called owner draw. And I recommend that you do not include yourself as an employee in your business. You do what's called an owner draw at the end. That means if there's money, if there's excess money, you take it out. Okay. If there isn't, you don't, obviously. Okay, so take a look at cash on hand, though. So this sort of starts to complicate things a little bit. So cash on hand is the total amount of cash accessible to the company at the beginning of the month. Does not include any of this stuff. Okay. However, if these are assets, you should keep track of them on another, page in your spreadsheet or something. But it does not include these in cash on hand, just includes cash that you can actually write a check on. You calculate it by the cash on hand at the start of the previous month plus earnings for this month. So if I had, and I'll show you an example. If I had $5,000 going into this month, and during the month I lost $200, next month I've got what, 4,800, right? So that's the way if I make a cash infusion, in other words, if I put cash in, I would include it there and make a note of it. Sometimes that happens. When we started out, we thought we had enough capital, fooled us. So we had to come back and put more money in. And so that was an infusion. The change in cash from month to month is referred to as cash flow. That's really what, and that's the one you want to watch like a hawk. I had to run our business for a little over a year. I had the two guys that we called each other partners. We were a corporation, but we called each other partners. And both of my partners got ill at the same time, and I had to step up and run the company, which was a horror story for an engineer. This is not what we signed on to do. But every day when I came to work, I had a cash report on my desk. That was just every day. So I knew where I was. Because if you run out of cash, you're out of business. You've heard of people doing a, what do they call it? You do for your business is your business, raison d'etre for your business. What do you call that? Like your business philosophy or whatever. What's this word for that? I can't ever remember. So what? No, it's the thing that you say, my business.
Mission?
Yeah, mission statement. That's it. Yeah. You want to know our mission statement in our software business? Make payroll. You'll find out that's what you worry about. We didn't have a lot of fluff. Right. All three of us were engineers, right? So that was kind of what it was. Okay, so before you start, establish minimum cash on hand. What's the minimum you're going to let that thing drop to before you start getting worried about it? Never, ever, ever let your cash drop to zero, because sure as you do, something bad's going to happen and you don't have money for it. You got to run out and you got to use it on your credit card. You got to run out and beseech your grandmother for money or something, and it's bad. Don't let it drop to zero. So we should never reject our cash dropping to zero, or if it does, you don't take any money out till it gets back up to that number. It's usually around 3 months operating expenses, but it varies from business to business. It has to do with your risk tolerance and, the kind of business you're in, how peaky and, is it pretty steady or is it seasonal, that sort of thing. You always want to establish this minimum cash on hand target. And remember, it's at the first of the month. This is at the first of the month, I've got to have this much in, right? So for her, we'll say she wants $5,000 minimum in her account. Okay, so let's see how it works. So the cash on hand at the start of the year is $5,000. So she put in $5,000 when she started her company. So we're going to estimate revenue and total cost. We'll say her revenue was 3,000 and it cost were 3,500. So she lost 500. Now you'll see losses on spreadsheets done 3 different ways, at least. One of them is red. Another one is they put parentheses on it if it's negative. And another one, which is really weird, they put a minus sign in front of it. Okay, so I just did that one there to show you that there's different ways that, and you can set your spreadsheet up to do it however you like to do it. Her owner draw there is 0 because she didn't have any earnings. And so what she did was she calculated her cash for the next month. To do this, we're going to have to add another row. Okay, so now we've added 2 new rows. And this row is called forward to cash on hand. And what it says is we're going to add the owner draw to earnings. Now remember, earnings is negative, so a positive plus a negative is a negative, right? So she's forwarding minus $500 to cash on hand. And then she just adds it up. That makes sense? So she lost 500, she had 5,000. Just took that 500 up, added it, and sure enough, now she only has $4,500 with it. So the next month, let's say she made 5,000 and her total costs were only 2,000 for that. You see her costs are varying, but that's very common for a startup business because you're buying stuff that that you say, well, I'll buy this when I got money or whatever. So her total cost went down. She made $3,000. Her earnings were $3,000. She's going to take out 2,500. Why would she take out 2,500? Why not 3,000? What? She wants to get cash back up to 5,000. Right. So she took all 3,000 here. She wouldn't have any to put up there. Remember, we want to try to keep that cash at 5,000, right? So she would only take 2,500. So then she can take that 500 and stick it back up there, and wahoo, we're back where we're supposed to be. That makes sense?
And then the owner draw for, like, in my scenario and maybe yours as a sole proprietor, one person that's going to be your payroll for yourself.
Yep. Or you could leave it in. You would say, well, I'm going to, or you could leave some of it in, right? It doesn't have to be anything. You could leave it to be, you could leave it 0, except if you get it too high, the IRS will gripe at you after a while because they'll say, well, you're just leaving it in there so you don't have to pay taxes on it. So they'll start yelling at you. But generally speaking, it's there for you. This is also referred to as a reserve. Okay. And it's absolutely fine to have a reserve. If you let that reserve come up to be at $2 million, I'd say, wait, Kat, you got to take some money out of here and pay taxes on it. You see what I mean? The IRS, but that would come after a year or two if you took nothing out and build up a lot of money in there. Because remember, in everything except a C corporation, in other words, a full-blown big corporation, and they'll be on accrual accounting, by the way. The corporation doesn't pay taxes. You pay taxes on it when you get it. You pay ordinary income tax on it when you get the money out. Yeah, you would be taxed.
On everything.
Yeah, the corporation itself would be taxed. Yeah, the others aren't. They had to pay an $800 fee to the great state of California to stay in business for a year if you're an LLC or an S corp. But you're not. It's not income tax. The income tax is collected from the people who the money is distributed to, and it's taxed as ordinary income. But you see why she took 2,500 instead of 3,000. And that was because she wanted to get back up to the 5,000, which was her target for reserve. Make sense?
Yeah, one more question. Doing more of an owner draw about
Is it the same thing for just not talking about that? I work too many hours, so I get too much money, but it's still, we're getting a check cut to us for a flat amount based on kind of as a friend.
Mhm. Well, if you're an C corp, you probably will go in as, at that point. You can still take a draw, but you take it as a director.
I guess that's my confusion, like, what's the difference between a draw and just an employee?
Payroll.
So
Payroll.
running it
So-
through payroll.
Right. Mhm. And it's an obligation. It shows up on your books as an obligation. If you've got an employee in there and they've got a salary, that's an obligation. You got to pay it. And you've got to withhold their tax and all that kind of stuff. If you're doing an owner draw,
You have that in your time.
So,
but as small businesses, you simply don't have, in most of them, just aren't steady enough to put yourself in there. And it's a lot of paperwork you don't need, you know. You can if you want to, yeah. Yes,
So if I have additional facilitators, I have to do all that tax breakdown. I can't just give them a tax fee and they still got themselves.
no. You, there's a big problem in California now. Used to, a very large percentage of workers were what we called 1099 workers. They were independent contractors. And the great state of California has really cracked down on that. You can still do it, but it's very difficult to use an independent contractor. If they were an independent contractor, yes, you're right. You just give money and good luck, right? But that was being misused. I got to say, it was being misused a lot. And there's huge pressure from the unions to our legislators to crack down on it. And when they cracked down, they kind of went overboard. It's very, very difficult to use independent contractors now. Very difficult. And it raises a red flag immediately. So
Some nonprofit organizations, if you come in and do a workshop for them, they give you a flat fee. They just give you a flat fee and that's it.
yeah, mhm.
And it's
That's
up to
fine.
you to add that.
But you're a company coming in.
Okay, okay,
Yeah.
that's what-
Yeah, if you go down, you know, if you I'm trying to think of something. Well, let me use my, if I bought some new software, right, from Microsoft, I just paid them, right? They were the contractor, I just paid them. Or if we, you know, if a remodeling company came in and painted the walls for us, we just paid them. We're paying a company, not a person coming in and working. That's different. That was all about, that independent contractor thing. So if you're going to do that, make sure and look at the rules for like right now, because they change them all the time. They change them every month. And a lot of businesses are exempt and some are partially exempt, and it's a big mess. So just be careful, because the penalties for doing it wrong are pretty serious. Okay, anyway, back to this. You understand how we're doing this, really simple.
I get
Okay.
that. I have one more question.
Sure.
Because will you come back to like the payroll side of things for
Sure.
sole proprietors?
Yeah, we'll talk about that.
Okay.
After we get the whole thing out, it'll start really making sense. You think you had trouble? I'm an engineer, right? First time I had to do this myself, I thought, oh my God. What's going on here? Okay. So actually, my two partners were both technophobic, which was interesting because we were a technical company. But I did the projection because I was the only one that could run a spreadsheet. I had power in that company, I'll tell you. Okay, then you finish the projection. You just rinse and repeat. Just do it the same thing month to month to month to month to month. That's the way we do it. And you set your spreadsheet up to do it automatically. So you'll spread your spreadsheet up. You'll put in your revenue and your total costs. Remember, those are in white. And it'll tell you what your earnings are, and it'll tell you what you had, you know, what your cash position is. You decide what you want to take out, put that in, and then it figures out the cash for the next month, and you're fine. Month to month to month. Okay.
still a little bit stuck on the owner draw.
versus salary?
Yeah.
Okay. What that means is instead of, like we had, obviously, we had in a software company, we had employees, right? And we had a company called Paychex that did our payroll for us. And we didn't take it. We didn't take salary. The three of us did not.
You waited until the end and split your owner draw?
What, we didn't take anything out for about 2.5 years. It took us about that long to get going. Remember, this is software with a long sales cycle, right? But we had to pay our, those little birds in the nest there with their beaks open, you have to put worms in there, like every other week, right? And so Paychex would do that. So Paychex knew what our payroll was. They figured it out. They cut the checks, sent them to our controller. She handed them out and she wrote them a check. She wrote, actually, she didn't write a check. She authorized them to take that out of our balance. That's right. But she never gave me a check, or Keith or Tom, those my two partners, unless we asked her to.
And then eventually we just do that correctly. Whenever the and certified, I put in the flat rate that I, but I was gonna have to do that.
It's very common. Yeah, that's the way we did, exactly. That's where, because if you put yourself in as an employee and you don't have enough money to pay it that month, and that could very well happen. Happened to us all the time, unfortunately. Well, but anyway, deja vu. But then you got to call up Paychex and you got to say, hey, this employee is not supposed to get paid this month, or instead of this, they're supposed to get paid this much. And it's just a big hassle. And at the end of the day, it's the same. It's exactly the same. You're paying ordinary income tax on it. So it doesn't
I
matter.
don't have employees, so I'm coming from a different perspective.
Yeah.
I think employees apply to that one to have a corporation.
Exactly.
When you put on your hours and your own time into your own business, that the only option is to. You cannot hire yourself. You are a person.
That's
Right.
part of my reason for coming today, because they're, especially after the last year of having to go through all of the stuff with P and applying for all of these.
Oh,
things, and
yeah,
the
what a
sole
mess, huh?
proprietor Really got left out of a lot of stuff, but there was a lot of documentation that I needed that I didn't have. So, and then there's another thing, as far as like sole proprietors can have, you might want to know the solo 401ks I just learned about a few years ago. And in that situation, you do set yourself up as an employee and the employer for your
Mhm.
retirement.
If
So
you're
it's like a
using
lot of
that one,
different- Yeah, so I'm just trying to understand, like,
Mhm.
you're unsure of your income every month then, as the owner?
Yeah.
Do you have an employee savings plans for yourself? The equivalent of a 401k. Do you have one for yourself?
I do, I'm still working.
But not out of your company. Okay, there are others than 401ks for proprietors that, and not proprietors, for owners of businesses. There are other savings, deferred tax savings plans, that's what it is, other than 401ks that you could use too. There's a whole bunch of those. I'm not an expert at those, but there are some people around here that are.
So the benefit of the solo 401k is that you can contribute to yourself as the employer and the employee.
Yeah.
So you get.
Yeah, you just have to make sure you just keep your books clean. That's the main thing. Yeah. Okay.
Thank you, John.
All right. So this ought to work for Annie. This works just fine for her. You could literally run a one-person consultancy like this. If you just kept track of all this, you'd be fine for her projection. So she'd know remember, we're projecting now. We're not keeping books. So that's different.
Okay.
Yeah, remember that.
Yep. Yep.
Okay. Now, we're going to have to set this up for a little bit more complex than one-person consultancy. So let's get into that. Okay, so first off, we're going to split out costs into what are called variable and overhead. some people call these fixed costs and variable costs. I don't like the idea of fixed, and I'll show you why in a minute. So a variable cost is cost directly associated with doing the goods or the services. If you were selling hamburgers, it would be the cost of the hamburger and the cost of the employee that made the hamburger. Just that much time of that employee. It includes, if you're a retail or an online business, when you do your online business, this will include like boxing it up, shipping and all that's direct. Because you wouldn't pay it if you didn't have the sale. In other words, this is something you only pay if you have the sale, right? Overhead, which is I like a lot better than fixed cost, because fixed costs aren't really fixed. They just don't vary with sales. That's all. Take a simple example of a trucking company. Trucking company's got one truck when they start out, and they're paying the debt service on that truck, right? So $800 a month cost them, you know. So 6 months or so, business is good, they buy another truck. Is their fixed cost still $800? No. Now they got $1,600, right? It just didn't vary directly with sales. Indirectly with sales. Everything varies indirectly with sales if you think about it. But so that's why we call it overhead. That includes something called G&A, and G&A is general and accounting. And that's the stuff you have to pay for no matter what, like rent, insurance, stuff like that. Doesn't matter if you got to pay it. Okay. Insurance, if you're an LLC or an S corp, you're $800 a month at the end of the year to stay in business. Then there are other costs. Marketing is always one. Marketing and sales costs that are not directly, in other words, if you have a point of sale system, you have to pay that by the month, right? It doesn't vary with, it's not a variable cost because you have to, even though it's associated with sales, it's there to do sales with, right? It's not a variable cost. That makes sense. If you have an R&D program, it goes in here. For the software company, we had a very large R&D budget. That's what we did. You know, people used to ask me, how do you protect your software? Do you have, a patent or copyright or whatever? And I didn't. I didn't have a patent. I didn't have a copyright. Here's what we did. If I was shipping version 3.1, version 3.2 was in test, and version 3.3 was in development. So if you stole the source code to 3.1, by the time you got it going, and you'd be at least 2 releases behind. You'd be selling obsolete software. That's the way we did it. The back of a tiger. So, not saying you shouldn't protect intellectual property, but sometimes it doesn't make sense to. Okay, but R&D or develop, or if you have an expansion program, that would be in there. Make sure all of these have both material and labor costs. So we're going to have to introduce something called margin. And a margin is just revenue minus variable costs. So if you heard people say it's a high margin business or it's a low margin business, like grocery stores are very low margin business, meaning the difference between what they pay and what they get is only about 3.5% for most grocery stores. They run about 3.5%. They're running right on the ragged edge. And why do they do that? They do it because they have to compete. They don't like it, but they've got to do it. Okay, so essentially it's your revenue. Remember, that's money you actually get. And the variable cost is the cost that you actually spent getting that revenue. The difference in those we call margin. So that's a buzzword B school term but if you hear somebody say, hey, that's a real high margin business, we ought to get into it. Now you know what it means, right? So this refines this idea of earnings. So earnings now equals margin minus overhead. So overhead is all the stuff that doesn't vary directly with sales. And we're going to get some examples of that. So then the rest of it is just like it was. You have order, draw, forward to cash on hand, just like before. But the important takeaway here is we have this variable cost, meaning what you actually paid to get that revenue that month, all right? Subtract that from that, you get margin. Your overhead is what you had to pay that month. You didn't have any choice. And you subtract those two and you get earnings. Okay. And everything's the same after that. So now we can do a little bit more realistic example than Annie and her bookkeeping thing. So we're going to do Acme Tonsorial Parlor. This is a great moment when I got to do this. I always wanted to start a company and name it Acme. Did you ever watch a Roadrunner? Yeah, Wile E. Coyote's always buying these stuff from the Acme Bomb Company or Acme Bow and Arrow Company or, Acme Rope Company. So, and when I first did this and I reviewed it to a bunch of score weedies, I asked for comments and one guy just sat there and I thought, surely I must not pay attention. He said, well, I have just one thing. I called it Acme Barbershop. And he said, that's not fancy enough. So I called it Acme Tonsorial Parlor. That's how it got its name. So I didn't do that. Okay. Acme has 3 revenue streams. Excuse me. This is one of the reasons I chose a barbershop, because it's a small business, but it has different kinds of revenue. A revenue stream, that's another B school term. And what that means is it's ways that money come into your business. So they have 3. One of them is hair care, obviously. Go in, they cut people's hair and they pay them, right? They sell hair care products on site. And they also do what they call chair rental. It's very common in the cosmetology business, where what that means is they'll have a chair and they rent it out to another cosmetologist. And they usually provide consumables, like a little piece of paper they put around your neck, whatever. Anyway, that stuff. They don't have a development program. They don't have R&D. Yeah. They might say, we're working on a new, on a new program, like they might. The way that I got the setup, it's men's hair, which is pretty simple. That's the reason I did it. But if it was ladies' hair, or maybe they want to do for performers, they would have to set up something different. So that would be a development program. We got to get a new sort of salon, or maybe they wanted to start spa business, whatever. But they don't have any of that. They just want to run this thing as a barbershop.
What is R&D?
Research and development. Research and development. As I said, in software, it's a big deal. Most companies software is the worst one, I think. Okay, so let's go. We're going to build on some prior work, and I want to review. Did any of you take the business model class? Too bad. Canvas? Yep. Did you take it? Okay, so we're going to review that. Oh, okay, good. So I won't bore you then. Okay, we're going to build on some prior work here, though. Okay, so since Acme is a startup, okay, we're assuming that we're doing it for a startup. First thing we did was we estimated startup costs. Then we did a value proposition and a business model. I'll go through each one of these, okay? And for the value proposition, we use something called the value proposition canvas. And for the business model, we use a business model canvas, right? And we'll go through this very quickly, but I want you to know how we got where we're going. And then we'll use these to guide the financial projection. So let's take a look at them. First off, the startup cost estimate. Here's the startup cost. And simply what we did, we just listed all the stuff that it took to open the doors, right? And the total was almost $35,000. Costs almost $35,000 to get the door open, right? So then what we do is we estimate our what's called required initial capital. Obviously, we need 34,745 because that's what it's going to take. We also had a minimum cash on hand. Remember, that's the reserve. And so we set that at 5,000. It's coincidental that we set it the same. We also have what's called an expected initial loss. And the reason that's important is because almost all companies lose money for a little while once they start. I've never heard of one going in the black the first month. So he estimated his initial loss at $3,000. Okay. That is an iterative process, and I'll show you when we get a little later on. You actually, what happens when you do this in real life, you go do a projection, then you go look at your business model and, oh Lord, it won't work. So then you go back and change that a little bit. And you just do it till it works. Okay, and we'll go over that. We assume he got a loan for the startup. He got a $35,000 loan from a micro lender. There's one here in town called Accessity, used to be called Axion. They just changed their name a couple of months ago. They're what's called a micro lender. I got a 72-month loan at 11%. It's very typical for a micro lender. His monthly payment is $666, and no, I didn't do that on purpose. I thought about changing it, make it 11.5% or something. It could come out different, but there we go. Okay, so again, we identified the items, prepared a budget, made initial estimates for the minimum cash on hand and expected initial loss, arranged for the loan, and he had $10,000 to put in himself. Anytime you get a business loan, the lender is going to want a very good financial projection. And they'll do something they call due diligence, which is like an anal exam. It is really thorough. They'll do that and they'll come back and they say, okay, we'll loan you 85%. They'll never loan 100%. They want you to have what they call skin in the game. Okay, so that was his skin in the game. By the way, sweat equity is valueless to a lender or an investor. We don't have, I belong to an investor group that have anything to do with SCORE, but an investor group here in town, and we do a lot of investment, but we do not value sweat equity. We value it emotionally, but not financially. And lenders, investors just don't do it. Okay, they just, oh my God, I've worked on this thing for 6 months and didn't take any money. Oh, so does everybody else. Okay. Okay, these are some sample entries for that checklist, and I just put them in here. We won't go through them now, but you'll have them when I send you the copies. So it's just kind of like a checklist to make sure you've thought of things. I got these, by the way, by combining all of those. There's a company called Vertex 42, the CDC, which is a small business lender here in town, the SBA, SCORE, and National and SCORE San Diego chapter, everything they had, and put them together and took out the redundancy. So that's where I got this stuff. Okay, so this is what's called the value proposition canvas for Acme. Value proposition means simply, what are you selling, who are you selling it to, and why are they buying it? Most important thing you can possibly do for a business is to understand that. Sounds simple, right? What are you selling? Who are you selling it to? And why are they buying it? That's a value proposition. So this is the way it works. Up here, my company name is Acme Tonsorial Parlor. My customer segment, who's buying it? Men and boys in Point Loma. Okay. My revenue stream that this is good for is all of my products and services. That's all in one big revenue stream. I don't break them out because it's not necessary in a small company like this. Okay. So the motivation to buy is the people want affordable, modern hair care. That's why they're buying it. That's who's buying it. That's why. We usually say that people buy because they have a desire or a problem or both. So there's in this case, they have both. Their desire, they want convenience. They don't have to go down and wait an hour and a half for their turn. And they want to purchase their groomer products at the shop. Remember, these are men buy, women shop, right? So they just want to go in and pick it off the shelf and give the guy some money and get the heck out of there. Okay. So the problems they have are long, boring wait times. They don't want that. And they don't want an unpleasant experience or outcome. So what we have is moderately priced, and these are the services that we provide. Haircut, shampoo, share, big beard trim. That's what this company provides. How do they address convenience? Well, they're open weekends and evenings, and they have online appointments. See how that works? Okay, but now think about it for a minute. What we're doing is we're identifying cost items here, because this means we got to keep this little Hummer open pretty much, long hours. So we have to have enough people around to cut hair during that time, right? We can't just keep the door open. We have to have barbers in there. Online appointments mean we have to have a system to take online appointments. So this all starts to impact directly your costs. The other thing, purchase grooming. Okay, so we have curated grooming products available. That means we got to have inventory. We talked about inventory a little bit. You don't go buy one bottle of, somebody comes in and they said, okay, good haircut, I want a bottle of shampoo. You don't say, okay, Ralph, will you go down to 7-Eleven and buy some shampoo and bring it back? No, you have some on hand, right? When you buy them, you have to buy them in bulk. And that means you have to pay for them in bulk, and you sell them one at a time. So you got to keep account of that. You got to have a big cost every once in a while and a little bit of revenue for strung out after that. Okay. But you can see why these start to hook. It's extremely important to know this stuff. Long, boring waiting time. Okay, reservations are available. And also we have beverage and snacks and television and magazines, all right? That means we got to have a TV up there, and we have to have snacks and magazines, which are cost items. Okay. The unpleasant experience, we have an online complaint system. Very important to have a complaint system. If you have a complaint, do not pass go. Address that complaint instantly. I see people that go into Yelp and they got complaints that aren't addressed on the poor practice. We got to publish the staff bios. So that means we have to have a website that we can do that on. Okay? More cost items. And then over here, this just says that we got to have we got to pay, premium for our employees. So all of these things that impact the cost of your, like I say, there is nothing more important than starting off with this. Like for instance, marketing. The only thing that you want to do is that, for the marketing, because nothing else is relevant, right? If it's not something that's either satisfies a desire or solves one of their problems, what the heck are you telling them that you're doing it for? We got a smooth parking lot. What the heck is the deal? Okay. So we then map this to this business model canvas. We have a workshop that does this for 3 hours, so I'm really flying through this. So what we do is we map this to something over there called, in case you can't read it, it's customer segments. Okay. And it just maps in. And we map these two, which are our value propositions. That is our haircuts and stuff, and the stuff that we're selling. Right. However, now we run into problem number one. We said that we're going to rent out chairs, right? What do you do that? That has nothing to do with men and boys in Point Loma, right? It has to do with barbers. They're the customer. Remember, the definition of a customer is somebody gives you money, right? So what we do here, we could do a whole different one of these for those people that rented chairs, but because it's so small, we're just going to stick it over there in the corner. So that says this isn't something that's got rules, and if you don't do it exactly like the rules, it won't work. This is a minor, it's a minor customer, but a minor customer segment. It's just one you want to keep track of. You see when we actually do the forecast how they contribute. It's significant, but minor. Okay. So now we got this, and we just fill it out. Start off with the channels. That is, how do we communicate with the customer? We have to have a website, a smartphone app, and of course, telephone. Why? Because we said we were going to take stuff online, right? We said we are going to post the bios. This is the customer relationships. We take appointments online or by phone, publish the information, and provide the complaint filing and resolution system. So again, cost items are starting to pop up. And our revenue stream are three, actually. Payment at time of service for barbering operations. They get the haircut, give you money, leave. Same thing for the grooming products service. It's cash, that's called COD, cash on delivery. It's even called COD if you're in a store. Did you know that? Store is a COD because with the deliveries, you took it off the shelf, but self-delivery, I guess, but you paid it when you left. So, and then chair rental, they just pay by the month. Okay. That side over there is generally called the customer-facing side of the business model. By the way, business model canvas is not a business model. It's a tool for making a business model. A hammer is not a building. Hammer is a tool for making a building, right? So that's what this is, a hammer. It just is a way to organize your thoughts. Okay, the key activities, there's three of them: provision of the services, shop management, and marketing. Those all have to be covered. They're all cost items, and they have to be given to somebody to do, right? Our key resources, our shop, and that means we had leasehold improvements. Like when we came into this area here, we used to be down on C Street, West C Street, 550 West C Street, in the SBA facility, and they gave us space, right? We used their copy machine. We moved out here. We moved out here because nobody come see us anymore. Traffic got so bad, nobody came. So we came out here because we were closer to the center of population, and you don't have to go downtown. We have parking and stuff. When we first came here, that VA building wasn't there. We had a lot of parking. Anyway, so this was just studs. So that's called tenant improvements. We had to put in all this stuff. Shop equipment, obviously, you have to buy it. And a website and a software, have to buy it. Okay, key partners, he's got one. That's a cleaning service. Key partner is somebody, if they don't do the job, it's big trouble. So if they don't come in and clean the shop at night, then the next morning it's a big mess and it's not good. They have some other people that do stuff for them, but they're not key. That's just a value judgment on your part. Okay, and then the cost structure. We just pull this off of here. We have staff wages and fees, right? Because you had the staff. Marketing is always a big cost. Fee collection, point of sale system, right? Our operational costs, consumables, cleaner, and equipment maintenance. And then the fixed costs are the lease cost of somebody's time to manage the thing, insurance, other stuff. So that's how that is just our business model. From this gives us our business model for Acme.
Before you did the bottom part with marketing, I was just about to ask you if marketing is a key partner. And then
It could be if you outsource it.
And then you showed it on the bottom.
Yeah, if you outsourced it, it would be here. Absolutely. If you outsourced it, when you get somebody else to do something for you, it's called outsourcing. If you outsourced your marketing, which a lot of people do,
Right.
it would be here. It'd be a key partner.
Okay, and that's what
Yeah.
I'm doing.
He does his own, I'm assuming.
Yeah, okay.
Who knows? Okay. You guys want to take a break for a second?
Sure.
Okay, we'll do that. Have you figured out a way to get the restroom open?
We're gonna use the method.
We couldn't even get the bins open.
Yeah, both were locked, but I think the other guy got it.
Well, that means that we just, the restroom's locked. That makes a lot of sense. Yeah, it does. So we probably ought to go out and paint out the white lines on the on the parking lot. That'd help too, wouldn't it? A bunch of idiots. Ah! Florence, you want some water? Here. Florence. Florence, would you like some water?
No, thank you,
Okay.
because the bathroom is not working.
Oh, I'm sorry. That was taunting, wasn't it? I'm sorry. I didn't mean it. I didn't mean it. I didn't mean it.
I was like, some orange juice in the car, and I said, I better not drink it.
Oh. Oh, no.
Working fine.
Is it?
Yeah, it's working fine.
How many people we got on?
We had a guy and he's gone. I don't know what that's about.
Call him up and ask him why he got off.
I don't understand why we have this many people sign up and they don't show.
Yeah.
We had one the other day, we had 5 people signed, 1 person came.
Last Saturday, we had a workshop. Had 14 people sign up.
It's right after the
3
elevator.
showed up. And then I got an email from,
Yeah.
uh,
I don't think it's
well,
working.
sure, Greg, I think. And he said, got a problem with the with Engage. And I said, what was it? And what are we going to do about it? I didn't get an answer, so I don't
I
know.
don't know.
Nothing works until it's tested.
That's very true.
You know, it's, we had 9 people sign up today.
What's all the names?
Well, I didn't know that they were going to do this one online also. So some people could have signed on online. I didn't realize of that.
Yeah,
Somebody
I didn't see that till the
bothered to tell me.
last minute that, you know, you can do it online. But it Specifically said in the initial email was that in person only.
Mhm.
And so I just, okay.
I saw that too. So I thought, well, okay,
And then
I'm,
I saw the Zoom thing, I said, okay, but I didn't want to take a chance. I said, you know what? Let me go.
yeah, I've got,
Probably, if I understand correctly, they'll send you a link where you can.
Oh, okay, okay.
That's my understanding.
Yeah.
by the way, do you get modeled releases or have they got that in our agreement for next year?
And what
Model release.
model?
Yeah, you can't release that without my permission. You can't.
And it asked that up front, I clicked it, so.
Huh?
that's my fault.
You can't. I'm not going to do, I'm not going to sue SCORE, but I could.
If you want me to stop recording, I'll be glad to.
No, it's just, again, nothing works till it's tested. Yeah, right.
If you want me to stop, but I'll stop.
No, it's
Were
fine.
you-
That's
were you
fine.
all able to get it?
No.
Leave it alone.
Yeah.
Are you leaving?
I'll come back. But I need
You
to-
can't get it open?
No.
Where-
Neither
where-
is the
where-
tour guide. Yeah,
I looked all around the house, but I can't find it.
so I'm gonna drive.
Did you ask, could you call Pam and ask her?
I didn't, I don't know.
Let me try it. She might have a key in her desk.
She just got the same keys that got there.
I'm so sorry.
I even looked to see if they had construction stuff out there.
I like how you put that.
We may
I
have
really
one over
apologize.
here.
but.
Well, there's a restaurant across the street over here. In the village.
Oh, that's what I was thinking, that little strip mall. I'll go there. I'll be back.
Okay, why don't you take, go ahead and take a break. If we go over, we go over. I don't care. Yeah, go on, go on, go on, go on. I'm really sorry.
We'll be back.
Check into the bathroom thing. That's not good.
Yeah, it is not good. So you still live in Point Loma?
I live downtown now,
Oh, really? Where at?
Burkittsville area.
You like it?
I do. Yeah.
A good friend of mine moved down there. She bought you know where the American Plaza trolley stop is, where the curve is? About 2 blocks, sort of like north of there. There is an older, old meeting, it's over 10 years old. That's old for down there, you know.
You're super sweet about it.
Condo building. And she's got a condo in there.
Columbia District.
Yeah, really nice. Really, really nice. Yeah, I like it a lot. I'm going home. Well, back to my hometown next week. I'll be there for. I grew up in Oklahoma.
Oh, where?
It's a little town called Marlow. It's down right next to the Red River. It's about as redneck as you can get. And not be in Mississippi, I guess, but it's just, for instance, I'm staying with my sister. She doesn't have the internet. So if I want to use the internet, I have to go to my cousin's house or the public library. We have a spotty cell phone.
Yeah.
So, but I love it back there. I do. I've lived here most of my life, but I came out here to go to graduate school. That tells you how long I've been here. Yeah.
Different piece of life.
Oh, yeah, completely different. Yep. So, but I do like it back there. I've got my daughter and grandson, wife live here. I would probably not if it wasn't for them. Yeah. It's better, sort of. You don't have all this crap to put up with, you know. Traffic jam is somebody else is waiting for the light. A traffic jam there is there's somebody else in front of you waiting for the light. You know. So, so did Liliana say she was going to come back, or she was disgusted and went home, or what? Is she? Well, we could go ahead. She's a score person. She's, yeah, I don't want to. Okay, now where's my, oh, there it is. Okay, so you remember all this stuff? Okay, y'all need a reset, or we okay with this? Remember where we were? Okay, the main thing is, sure, we just wanted to, this business model, the business model says, how does your company work so it makes money? Remember, there's 2 things, a value proposition. Those are B school terms. Why do they use that? I have no idea. That's what they named it. But the value proposition says, what am I selling, who's buying it, and why are they buying it? Okay. And the business model says, how does my company work so it makes money? It just breaks it down into pieces. It's a process of decomposition or abstraction, or whatever you want to call it. Okay. Now what? Oh, I don't know if this is going to work or not. We had to go to screen sharing. So I don't know if this is going to, let me check here. Okay, we're okay. Yeah, it is. You know, I told you that unknowing to me, and I again apologize, this is the first time they've put one of these online. And I'm going to be switching back and forth between the spreadsheet and the PowerPoint presentation. And so to do that, we had to go do some screwball things through. So bear with me. Okay, anyway, so we're going to, now we're at the point where we could actually make a financial projection. Okay, so again, cash on hand, revenue and variable cost, remember what that is, margin. Remember the yellow ones are calculated, the white ones are entered. And this one is blue because it's entered one time for a startup. That's why I made it a little bit different. Okay, so that's margin. Overhead, we had G&A, general and accounting, and marketing and sales. Those were the two that they had. So total overhead. The difference between margin and total overhead is earnings, owner draw, and forward to cash account, just like before. Owner draw should be white, by the way. Mistake. Told you I did this yesterday and forgot. Okay. So this is what you would set up. Set up the summary first, because what we're going to do is break it apart. And it's easiest to do it this way. For me, I mean, you might want to start the other way, and that's fine if it works better for you. Okay, so first thing we're going to do is split overhead into G&A and marketing and sales. So we have now just major, these row headings here. This is the summary. So these are, we would call major headings at this point. Okay, so remember, we had revenue streams in the business model canvas, did we not? There they were. So what we're going to do is just pull them out. Those are the revenue streams, remember? And those then become revenue. Be nice to me, would you please? I'm an engineer and I can't help it.
No, it's good.
Okay. Okay, but still wanted to show that it isn't, you do in fact use that stuff. Because a lot of people are looking at, well, I'll do a business model canvas so that I'm through. No. That's just get your, you know, this is what you should do with it. So those are your revenue streams, right? Okay, these were our cost items. Remember, the ones down in the lower left are called our cost items. So we do the same thing. Pull them out, and these then become variable costs and overhead. So far, so good. Huh? So I'm just trying to motivate you to do the other one first.
It's working.
Yeah. Okay. Good. So these are sample G&A expenses. So again, this you'll just get this, and I went through these websites and collected them and stuff. Okay. All right, so we want to start a new spreadsheet page for G&A. So what we want to do is to arrange the items into subcategories, if possible. So we have a staff barber, administration, debt service, and shop expenses. We start off with what are the expenses, right? So we make the spreadsheet page, which is going to be our costs. And then we sum them up. So his cost is, he's got a staff barber. The staff barber has a base salary and and commission. The base salary goes here because you got to pay it, right? So that's one of the things a lot of people have to handle. They say, well, if I got somebody that works, you know, on regular stuff sometimes and works on sale and stuff some other time, this is the way you do it. He has a base salary plus a commission. His commission will go into variable costs because you don't pay him the commission unless it, you know, got somebody's hair or something, right? Okay. Administration, we said he had an accountant, licenses and permits, and a CPA that does audit and tax stuff. And you can see where those are put in. He has a debt service. This is a startup loan, remember? Right there. Have to pay it every month. Right. The shop expenses are his lease, utilities, janitorial. This monthly internet. Snacks and beverages, I assumed would be 1% of revenue. Because that's going to change with the amount of people come in, right? So you probably should tie that to revenue. And I just said, okay, it's 1% of revenue. Magazine subscription, I don't know. I don't subscribe to anything but online stuff. So I don't know how much they cost, but let's say $100. I don't know. And then snacks and beverage. Oh, wait a minute. This is important. His business liability insurance. Okay, pays it by quarter. Notice that some of these are paid monthly, some are ad hoc, and some are quarterly. We then link this G&A page to the summary page. So every month, the total here this goes in there. This is the summary. Okay. You see how that works, right? So we set up, that's why we set up this summary page first. We know we want to collect all of our G&A in one place. So then when we make another spreadsheet sheet for G&A, then you just take the total of here and put it in there. In a spreadsheet talk, this cell will have a little formula in it, and it'll say equals in that cell. So it'll just pop in there.
Refresh from just my orientation purposes, what spreadsheets we've currently created based on this?
What's that?
What spreadsheets have been created based on how we're doing this? Just for my orientation.
Well, I'm showing you what we do to do it.
Right,
The first one we did was this one,
right. And what do we call that?
summary.
Summary.
This one is G&A. The G&A, we've broken down into pieces, right? If you could do it on here, right? Except after a while, the spreadsheet's this big and you have to scroll, you'd never be able to use it, it'd be too hard. So it could literally be one spreadsheet, but it's just really, really inconvenient to do it that way. Yeah. So we set this up first. We knew this is what we want to keep track of. But we know we got to have details, right? Because otherwise it's just a WAG. What a WAG is wild ass guess, right? So this is what's called an SWAG, swag, scientific. Well, you break it down into these parts, but then you just take the total and link that total to that in the summary. Now that's what spreadsheets could do. They're good at doing that. I'll show you the spreadsheet in a minute. Okay. So we break down the marketing expenses. Let me show you one thing that we did. Well, anyway, I'll show you some examples here. Marketing sales expenses. So these are different kinds of marketing and sales. You have both periodic and ad hoc. You know what I mean by ad hoc? It's whatever it comes up. It's not periodic, it just happens. So that means ad hoc. Like trade shows, occasionally you go to a trade show, but periodic, every month you have to do those, right? So these are some typical ones. The sales costs are the labor of a salesperson except for their commission and expenses. They would only have their commission expenses when they will go and make a sale. Travel and expenses for outside sales. Those are directly related to sale. Fixtures, stuff like that. Okay, so these are sales costs. It's not the cost of it, like if they were, their case, they're almost totally service oriented. You're service oriented. You sell anything? Just services, right? Okay, so you're totally service oriented. These guys are a little bit both because I wanted to show both. If you were online retailer, you know, you wouldn't have this stuff, right? So, okay. Uh-oh, something's wrong. So here, what you need is a marketing plan, right? Marketing plan relies very heavily, obviously, on the value proposition. What are you selling to whom and why are they buying it? That is your marketing plan. But it's very tightly coupled to the financial projection. The reason is because I've had people come in with a projection and they show no marketing costs, but their sales are going up. And my question to you is, how are the sales going up? You're not marketing. The answer is they don't work. You got to, most small businesses spend a significant amount of their margin on marketing, around 30%. Most small businesses, successful small business. Remember, margin is what you have left after is your revenue minus the variable costs, what you had left. That's what you got to play with. That margin is everything you have. You have no choice to pay for the stuff that, if you're selling hamburgers, to pay for the hamburger meat, the bun, right? So the margin has to cover marketing. And it's very expensive. Good marketing is very, very expensive. Bad marketing is even more expensive because you don't make any revenue. But, right. So you need to have a marketing plan so that you can intelligently make out that line. Okay. That's a whole different. So here's some samples of marketing and expenses. I put these in so you'll have them. So guess what? We do a spreadsheet for marketing and sales. We put those in subcategories. So what we did was the marketing costs is website maintenance. Remember, a website is not one and done, ever. Software is never static. You'll be wanting to add stuff or change stuff or whatever. I assumed he would be every barbershop I've ever been in my life had a youth sport team, you know, like a little league or something. So they have a customer loyalty program and maybe one of the little cards, you know, fifth one free or something like that. So they have the total. Their sales costs are the credit card fees because he takes revenue via credit card, about 3.5%. I think most of them run something like that. The point of sale system lease those. So that's his total, and so that'll be his total marketing and sales, and that's what it'll look like. So you can see here he does $1,000 worth of his website maintenance is $300 about every quarter. That's pretty close for a small business like that. This was a guess. Credit card fees should be linked directly to your revenue. You have the percent, you'll see in a minute, we'll do something called a percentage paid by credit card, and then you want to put that fee in there.
So if they're paid by Cash App and all these other things, or whatever,
They all have a fee.
yeah, and so all of that.
You would put those in there. If you're gonna like Apple, a lot of people are paying by with their Apple phone. You've seen that, right? And Apple has a charge for doing that, obviously. PayPal has a charge. I did credit card because it's simple. Yeah, that can get really complex for a big company. But you've got to account for it because it can build up and completely obliterate your margin. Yes, ma'am.
I do have a question. Sometimes as small business owners, when you have to do with the numbers, the Excel sheets, particularly when it's not your cup of tea, how much time should a small business owner allocate to manage this kind of task per week?
Good question.
What would be your suggestion?
I put in 20% of his time for this person. So you'll see when we get to start to now. How many hours a week do you work? How many hours a week do you work?
Hands-on or total?
To your business, when you're doing something that is directly associated with your business. 50, 60 hours, yeah. We only worked when we were awake. You know, sometimes I dreamed about it. You got to be obsessed, you know, not motivated. Motivated isn't enough. You got to be obsessed. Oh my. Yeah. But I put in 20% of his time.
But when you have a tool like QuickBooks and stuff, that makes it easier, right?
It makes it easier. And remember, he's paying a bookkeeper to do a lot of that heavy lifting for him, you know. Now, you don't want to give your bookkeeper a shoebox full of receipts because it's going to cost you a lot of money to do that, you know. You need to be able, any of this stuff, you should be able to do enough so that you can read it, you can analyze it, and you know whether the person that's doing it is competent and is not BSing you. Okay, you should, any of these systems, like spreadsheet, you don't have to be an expert, but you should all be able to do this. The most exotic thing we did in here was an if statement. You know, most of it is adding, multiplying, and subtracting and stuff. The same thing for your accounting. You ought to be able to read the QuickBooks. So you don't, not maybe do it yourself, but take a couple of QuickBook classes. We have 2 of them here at SCORE. They're 3 hours a piece. Cost you $50 for both of them. Or there's lots of other places you can go get them. So that you're not an expert, but you could, if I'm your bookkeeper, number one, am I competent? All right. You could use the output of it, and if I'm trying to BS you. So, because some people do, if they know you could use it, the chances of that happening are diminish. Yeah. Okay. That makes it. Okay. So then again, we just link this to the summary page. So we link all of these marketing sales to marketing sales costs. Just filling up the summary page. Okay, well, so far this is pretty easy. That was the fun part. Got to break down revenue and variable costs. Remember, they have 3 revenue streams: hair care, product sales, and chair rental. We have to account for all 3 of these. So we'll go through each one of these separately. First off, we back off here and do an assumptions page. Okay, and the assumptions page is fundamentally this. This is the data for all your employees. You can read this. It's just what this comes off. What we want to know is how many days off do they get per year. So we know they don't work 40 hours. An employee doesn't work 40 hours. They work something less than that on the average. We also want to know, we know then there's only 238 working days a year. It's not 5 times 52. That would be 260, right? Because of this, that's all the, so net, they work, you could read it as much as I can. So this just says, when I'm paying a person's salary, what am I really paying for, right? Because you just have to inflate it by this much, that's all. Also here we have in financial, we said 75% of the time you'll be paid by credit card, excuse me, and they're going to charge you 3.5%. And then here is where he set his minimum cash on hand. And over there, the operating hours. Remember, we said we're going to be open late and on weekends. So we put that in there. So this is your assumptions page. So start off, when you're starting off trying to do this revenue and cost, that's the first thing to do is put your assumptions down. So let's look at the first revenue stream. Here are the services. I got this off the internet. I went to one of the barbershops. That's what they did. So don't shoot the messenger. Then we said, okay, well, how many a day are we going to do here? On the average, how many of each one of these will we do per day? And the consumables is, what does it cost to do that? This is your variable cost for barbering. Like I say, a little piece of paper they put around your neck and stuff. Shampoo, I don't know what they use. Also, very importantly, how long does it take? How long does it take to do it? So we say he does 15 services per day per barber. If this is they're working 100% and they're 100% loaded, which is important, okay? And it's about 5.25 hours. So you can say, well, he's there for 8 hours. What's he doing for 5? Oh, how come he's only working for 5.25? But this person has to get up, get out of the chair, right? Kind of sweep up around there. So it's not 100%. You can adjust this. You can say, well, I could really do only a total of an hour a day. We'll adjust it so that this goes to 7. Okay. It's really important to understand how that is linking. So remember, you only have 2 assets, time and money. And so you have to husband your time as well as your money. But you see what we're trying to get at here is just how many of these is he going to do per day, and how much revenue could he expect for it? Okay. We got to figure out, in this case, we got the staff barber. What is it going to cost? So we said we paid him $15 an hour, which I think is pretty common for, if you have I think they call them tipped in restaurants instead of commissions. I think they call it tips, but you have a commission or a tip or whatever. About $15 an hour is pretty much the base now. So that's a fixed cost. You got to pay them for showing up, right? Their commission in this case, 10%, and you can see this, he would average based on that, how much he can work per day. So his wages are little over $3,000 per month. That is base salary and his commission. However, you've got to pay the taxes and stuff. And on the average for this kind of employee, it runs about 15% of total compensation. That's sometimes referred to as acceleration. If you hear somebody say, what's your wage acceleration? That's what it is. You say, hey, this is how much I actually pay my employee, and this is how much it costs me. Because you got to pay your half of the Social Security and, you know, disability and stuff like that. Okay. So totally, that barber is going to cost you roughly $3,500 a month, about $19 an hour, $37,000 a year. That's why, remember, cost is what you pay. So any of your employees you need to do this for. Luckily here, we only had one employee. So, but if we'd had more employees, we'd had to do one of these for each one. Okay, so then you create the revenue page. So we'll go over a little bit at a time. It makes it pretty much easier. But you see where we are now. We know per hour worked what it's going to cost us. And we know what we charge for them, right? So first off, let's talk about services. We do something called a loading factor. And this is how much in the day is this person. We only have two here. We have the owner and the staff barber. There's only two people working. And getting, there may be somebody else working in, but that is working in for revenue. It's generating revenue. Are those two people. And the loading is simply the percentage of the time that they're actually working in the sense of getting revenue. They're doing something for which you are getting revenue. They don't do it 100% of the time, right? If you, in your wellness course, for instance, how much of your time do you think percentage are you with a client versus to the total amount that you're in the shop? Yeah, so that's 20 to 30% is admin, yeah. So you would load yourself up here for the purpose, remember we're trying to estimate cost of revenue here. You'd load yourself up as 70 or 75 or 80, whatever you thought was right. Okay, that's what that is. Then we create a row for revenue for each service. So we take this loading factor, multiply times that, you know, how many percentage of each one of those services, put it in here, and then we know how many dollars we get for it. So this is the number of popular haircuts and the fees that they will get for that per month on out. I want to make sure you understood what we're doing here. Okay. Excuse me?
That's why you get a bookkeeper.
Well, you got to do this, unfortunately. No, you got to do this because you got to understand your business.
Right.
If you don't understand this, you're in the dark. So we know how much percentage we're going to be doing it. And from that other thing, we knew how much in each day is spent on each one of these different kinds, right? And so one of them was these. So we just say, okay, well, there's that much. And we can calculate what this would be on average. And then we have the amount we're charging for it, which is our price. So that's what we're doing here. Okay. So we're going to set it up. We're going to do this popular haircuts one time. So this is the loading factor. Okay, let's go over this a little bit. I'm assuming the first month he's only 25% loaded. It would not be realistic to say he's going to open the barbershop and be 100% loaded. It's just not realistic. So I said, okay, 25%, 50, 75, building up to 80. And at 80%, he flaps out because 20% of his time is sitting. Okay. So it says up here, when he's flat, he's completely loaded about this time. He's going to bring a barber on. Going to bring on an employee. That person will probably start out at about 50%, 75. They'll get pretty close to 100% because that's all they have to do is to put really good hair. Now, if you think this is where this, it's a judgment call on your part. If they have dead time, you would adjust it. Employee has dead time, you put it in here. But you can see here, this is the total percentage of time of a barber that's being spent at each one of these. Okay. See what we're doing?
So, sorry, so just summarize of the total barbering operation. Okay,
This is expressed in percentage. This is expressed as a decimal because we're going to use it to multiply later on.
And that is telling you the total.
Of time that he's open, that he's doing.
That's something other than billable.
Exactly.
Okay.
And here he's dead time because he just not, his business hadn't been built up yet.
Okay.
But after he hits here,
That's the-
20% forever is administration. Okay. Okay, so then by the magic of spreadsheets, this will tell you how many popular haircuts he does on average per day. I'm sorry, on average per day and what the revenue is going to be per month. So he's going to have $694 revenue for popular haircuts based on our assumptions per month. When he started, it builds up. You can see it climbing up as his shop business opens up. And you see where this is really useful in what ifs, because you say, well, what if I bring another employee on? Well, don't bring them on as 100% going the first month, and what is their contribution going to be? This is the way you do it. Okay. So then we just complete it, right? So we had popular haircut, just went through that, do the same thing for all of the services. What do you have, like 7 services or something like that? So hopefully for the rest of them. That's just for each one of these services, just exactly the same thing we did here. Exactly the same thing. But if you're running that shop and you want to take a look at this and say, do I really need to be given all these services? Do I have something in here that's a pain in my behind to do, but it's not generating a lot of revenue? So stop it. Okay. Oh,
Useful to make decisions, right?
yes, that's what projections are all about. So you could go in and do a what if. What would happen if I drop this one off and I could keep loaded? I could use that time for something else. Yeah, it's a judgment call, but at least you got some way to figure out objectively what would happen based on the assumptions that you have. And the longer you run the business, the better your assumptions become. So you can see his total service revenue there. His first month was a little over 2,000. And by the end of the year, he's doing almost 15,000 a year. Service revenue. Okay. 15,000 a month, I'm sorry, by the end of the year. Over here. Okay, so now we need revenue and costs for the products. Okay, remember we had 3 costs, 3 products. Remember, price is what you charge your customer, cost is what it costs you. So this is the price each of hair gel, facial oil, and beard oil. But here's the problem, you got to buy them at 100 each. You can't buy, like I say, you don't send somebody down to 7-Eleven to get the stuff where the person wants to buy it, right? So you have to buy 100 of them at a time. So we just, we create a revenue table. The number of hair gels and face lotions and beard oils we're going to sell per month. And then you just multiply that times the price and, the price, and you got it made.
And how do you manage that when you have those startups on one site?
Excuse me?
How do you manage that when you have those products that you're gonna resell as consignment from your payers, that you pay on the base of what you sell base?
Sure. Well, we have a lot of people coming to the store that are doing affiliate marketing, which is quite similar. And essentially what you have to do is set your spreadsheet up so you know when you sold it, right? And when you get paid for it. And that you'll talk to your whoever you're doing business with, and they'll have their rules set up. So if you sell something, right, where do you get the money for it? And you want to be able to keep track of all that. Now, if you are inventorying it, which is not affiliate marketing, the other person is doing what's called fulfillment. They have the inventory, they ship it. But if you're inventorying stuff, then you got the same problem this guy has with his hair care products. You got to buy a bunch of them, stick them in the warehouse, which might be your garage, but it doesn't matter, it's still a warehouse, right? And then you ship them out and you get paid for them as they go out. So, but again, just what you do is you just follow the money, right? Cherchez l'argent. You know, there's a restaurant in Paris called Le Tour d'Argent. And the word in French, l'argent, is used for two things. It's used both for silver and money. Its context is which one you mean. So Tour d'Argent really means silver tower, but it also means money tower. Some people say it's cheaper to eat money than it is to eat there. It's called Le Tour d'Argent. I don't know why I thought of that. Sorry. They're supposed to have the best wine cellar in all of Paris. Can you imagine what that's like? It's on Ile de Saint Louis, which is just behind the Notre Dame. And it said that John Wayne had the most extensive collection in there. Of all people. He had the wine cellar of the Tour d'Argent. That figures, doesn't it? Okay, sorry, I'm off base there. But anyway, okay, let's go back to this. So we create the revenue table. Link it up to how many we said we were going to sell. And this would be our total product revenue for this. So all we did was just, once we had that done, we just put these numbers in, which was from our assumptions. Stick it in there. It's your assumption, you know, how many are you going to sell? I don't know, beats me. But once you get experience, you'll be able to fill these out. At first, it is a wag the first time, but do something. I mean, you wouldn't go in there and put 500 of them. That wouldn't make any sense. So what is reasonably to be expected, I guess, is a good way to say it. Finally, revenue for the chair. So we had that in there. Remember, it was $150 a week. And we're going to give them the consumables. Remember that? So we had to provide consumables for them. And we just estimated the consumables that they're going to do the same amount of haircuts as our employees is going to do. So just probably a reasonable assumption. We're charging them $150 a week. We just, again, generate the table. We estimate the number of chairs rentals. So we said, okay, remember, he built up, got to full load of 80% about here, brought on a staff barber, who got up to about 100% by here. Then he would bring a chair. Otherwise, he's cutting into his own business. So he started this month, which is like the 7th month. And then later on, did another one for a total of 2 by the end of the year. So at the end of the year, he's getting about $1,300 a month for chair rental. And there it is, complete now. So it's not as bad as it looked. Think about if we tried to do it from here to start off with. That'd be really hard. If I think about it, if we tried from here to start off with. I'll send you the spreadsheet too, by the way. I have the live spreadsheet. It's in Excel, but by the way, Excel will import into Google and you can convert it to sheets by clicking which one you want to open it with.
Yeah.
Very, very easy.
Because that was one thing I was like, man, it's been like 20 years since I remember how to set up
Spreadsheet.
spreadsheet.
That's one of the skills that we have this workshop called,
The calculations.
yeah, getting ready to start your business. And that's one of the skills we recommend is basic spreadsheet skills. Yeah, there's a lot of good tutorials on the internet. They're free. Google has a bunch of them for sheets. And you don't need to be able to do exotic stuff. You just add, subtract, multiply, and divide, link one sheet to another one, and do simple if statements, if this, then that.
And believe it or not, if you go to a store or something like, I don't know, I got mine on Warwick. There are these laminated sheets with a list of all the functions.
Cheat
Excel.
sheet,
Yeah, cheat sheet.
cheat sheet, they're called.
So instead of going on how this is done, you just have it on there and it really, really helps for us who are not very.
Yeah, there's some you can download also. Google's got some, yeah. But you should know how to do this. Like I say, the most exotic thing that's on here is an if statement, and that just says, if this is bigger than, let's say, if this cell is bigger than 5, do this. If it's not, do this. That's the most exotic thing we're doing. Okay, so that's just total revenue. You can see where, but notice that if you are now running this barbershop, you've got a pretty good view of where your money's coming from, right? Where your money is coming from. We don't know where it's going yet, but that's next.
No. I like to do this stuff.
Like my wife says, if it's easy, engineers could do it.
Your first one, I think the second one, the third one will get easier. The difficult one is the first one, and I totally understand, because I have no idea how to manipulate. Money. But like, you gotta dive in a little bit into your skills of the spreadsheet, but once you got your first one, and you will start to see, when you see the numbers, like potential that, what if I bring another service? I'm already having my platform, I already have enough clients. And that's how you can really come up with new forms of income or to increase.
Yeah, you're not flying blind.
Yes.
And also is what are the services you're offering? Are they all generating significant revenue in terms of percentage of revenue? Might be something you really like, but it doesn't make much money. So at least you know it. You might say, well, I'm going to keep doing it because I like it. And that's one of the advantages to having your own business, right? But at least you know that your stupid stubbornness it's costing money, right? But so this is an awfully good thing to do with a mentor. Yeah. So we got a bunch of people around. I'll help you. Liliana will help you with it.
I'm not inside, but this is so interesting. For instance, the ladies that we go to the salon to do our hair, like if they do the wash and dry and blah, blah, but then they add this little capsule of equipment, and that adds like $20 to your price tag, but it doesn't it doesn't cost them time. Right? So they make more revenue out of the same hours. So that's the way you have to think about it. That in certain businesses, right? I don't know if in your business, aromatherapy, music on the background, whatever. I don't know how is it, but like those added value items that doesn't have an impact in your costs, but you can add to the price to make for a better business.
Okay. Okay. So this now, again, you like that?
I just.
There's
Good.
another one.
Like, I appreciate that because I need to see the big picture. So it's helpful, but I'm overwhelmed by it each time we keep coming back to the summary.
I'm the same way. That's hilarious.
I'm like, here's another item.
Okay, so you just link this to that. Okay, back to the summary. This is all the revenue in the summary. Okay. Okay, next we estimate the variable costs. And remember, these are the ones that are directly associated. Again, we had consumable and the staff barber commission. Those we only pay if we do something, right? So we linked that, and that's pretty much what it was. This again was based off that table we had of how many, what it cost, and then how many you did per month in our case. This is the commission based on his activity. So remember, he started off slow and he built up, and this person built up to $853. Used to be I think they're still there. There's a very, you know where the olive tree is in Point Loma? Right across the street, there's this little teeny barber shop. It's about this wide. That two ladies run, but they're independent. It's amazing. So I wonder what theirs looks like. Okay, but you see how we're doing this. This is the consumables, staff barber commission. This is consumables for everybody, including what he brought on. Remember when he brought on the chair renter people, the barbershop was providing the consumables, so it has to pop up when it goes to there. Just again, it's just to link in all this stuff together. So we could complete that estimate. So we got rows for the cost in selling products. Remember, we have to buy them in bulk, so that's going to hurt. See here, product cost 6,000. Product cost 6,000. Here we thought we could run about once a quarter, and there'll be a small business starting out will be on COD business basis, cash on delivery. So when they deliver them to you, you got to pay for it, and then you sell them out over a quarter. Those are kind of bad. Okay, variable cost complete. That's your total variable cost by month for the month. So again, we link. You weren't watching that one. That would morph too. Anyway, so you just link it to the summary page. Okay, so there it's complete. There it is. All right. So what does that tell you? This is the person's earnings. That's a minus. Lost money here, made a little bit here, lost money there. You see, and you see how his earnings goes up here, and see how it goes up here and then it drops. That's what he has to buy that products. All of a sudden, whack. Yeah, you see that? Okay, so you can see how it fluctuates. It's not.
Share spreadsheet. Are they going to be the ones that you on the screen with values?
Yes, it's live too. Make a copy of it. Don't eat the seed corn, right? Oklahoma. So, yeah, make a copy of it and just play with it.
You want a cool trick on that?
What's that?
If it's in Excel, I don't know the trick, but if it's in Google Sheets, if it says edit after the backslash,
Yeah.
user read all that, copy.
Uh-huh.
And when you share it, it forces the user to.
Right. Yeah, just make sure that you don't just have one, or call me and I'll send you another one. But it will be Excel, I said to you, but you put it in Sheets that you can convert it to Sheets, or you can keep it in Excel. Google Sheets is one of the applications under Google Drive. When you get a Google account, you get a mail, obviously Gmail, and you get Google Drive. And under Google Drive, there's Google Sheets, which is a spreadsheet, Google Docs, which is like Word, is a word processor. There's one called Google Slides, which is awful, but it's kind of like PowerPoint, and some others. There's one called Draw, which is not bad for drawing. But so when you bring it into your Drive account, it will hold it as a Excel. So you can download it back down and it'll come down as an Excel sheet. But if you open it, you get your choice between opening the two, and then just save the Google one if you want to save it, or not if you don't want to. Okay. But you see here what this person is doing. Now it looks like he a draw of $50,000 that first year. Do you remember what the staff barber salary was annualized? 37.5 about. So he's doing better than if he went to work. Have you ever heard the term opportunity cost? Opportunity cost is what?
So the owner isn't doing any of the work? And this is
Yes.
part-
Oh, yeah.
oh,
That's that top line. Very top line of the. Go back right. See here,
Yeah, yeah, yeah.
owner
yeah,
loaded
that's what I
factor.
mean.
It scared me like that. I thought,
I
oh
know,
my
I
God,
know.
don't tell me I forgot to put that in
Right.
there. Ah, okay, so go back where we were. Okay, but here's the opportunity cost, excuse me, opportunity cost is the cost of you doing X instead of Y. So this person could have gone to work as a barber, obviously, and probably made 37.5 a year, right? So you can say he's losing $37,500 a year because he's not working. Do this instead. This is paying 50,000. So he's gained what in salary? So is it worth it? Don't know yet. Don't know yet. So what you could do then is take this. Let's review how he got here first. So first he entered an initial, first thing he did, set up this god awful spreadsheet, right? You enter the initial cash on hand. You link each month's revenue to the monthly revenue line. Each one of the costs to the appropriate cost category. And then enter the planned owner draw, and I apologize, those should be white. Okay. If there's enough money, and remember, he wants to keep that thing up there at 5,000. See here, this dropped here because of that buying that stuff. So he took a very small draw that month to get it back up to 5,000. Didn't have to put any money in. That's a good news, but didn't get to take much out. Okay, then you just set the spreadsheet to subtract that and add it to keep your cash on hand up. Do that.
So doing this projection,
Excuse me.
would actually let you know, okay, he knew it would be him and he have one staff and he have X amount of petrol and so forth. But during this projection, before you actually even open up, you could decide, okay, I'll have less chair rental and have more staff, have more products to sell. You know,
Exactly.
have that ability.
That's what it's for. Yeah. That's the what if.
Yeah.
Yeah. So you can play with all that, and it's got to work. That's the thing. If that was minus at the end of a year or better, you probably wouldn't do it. Or if he said, well, gee whiz, if I do everything really well, I'll make $15 a month. Probably ought not to do it, right? At least you ought to be making as much as his opportunity cost, break it even on salary, right? So that's what these are for. Just exactly what they're for. I could guarantee if it won't work on paper, it won't work in the real world. Because stuff happens, right? So this is it. What you could do from this, though, is make a little dashboard. And all I did here was to say, okay, let's just take this revenue, multiply times 12 for every month. So it's the equivalent of annual. It's annualized revenue. So at the end, his annualized revenue is about $200,000 a month. It's pretty good. A year, rather, I'm sorry. About $200,000 a year. Not bad. His cumulative earnings, the same thing, and his cumulative draw. So say it said his cumulative draw this first year was $50,000. Okay. And we said that's not a heck of a lot better than he could have done had he gone to work, right? But look at what it is annualized. It's 59,000 at that time because we did what's called a 6-month trailing average. We just took the last 6 months and averaged it and said that's the way you're running right now because he's building up. So this, because these are called a dashboard. You've heard that term, a dashboard for your company. This is what they are. Whatever is useful for you. That's what's in a dashboard. So here's something I did with, you can do this with Google Sheets too. But, I just thought you might like to see what's really going on. We have two lines here. This is the cumulative net. That is his net, his draw. Without opportunity cost. Or just, this is really what it really was. And see, remember his initial capitalization was $10,000. He put in $10,000. So it took him almost 9 months to break even. Remember, this is 0. And at the end of about the 10th month, he got his 10 grand back. Okay. So that's, he recovered his initial investment at about 10 months. And then it's going up, looks pretty nice. But if you look at this line here is this same thing with the opportunity cost taken out. It's to say what I made more than if I was working. I subtracted off what I could have made if I was working. And it takes him almost 20 months to break even. Almost 20 months. The long haul. The long haul. And this is a fairly optimistic projection, I can tell you. I've seen a lot of since I've been at SCORE. It's fairly optimistic. So it does, it does take it. Again, you got to be obsessed. But after that, it takes off. Now you are building, remember we talked about, there's the lifestyle business and the scalable business. You are building value in the company, and you could sell it. So you have, it's not, the lifestyle don't mean you can't sell it. It just means that's not your goal. But you could. You know what the #1 cause of successful business being sold, small business? What do you think? #1 cause of a successful small business being sold? Burnout. By far, burnout. It's got tired of working 18 hours a day or doing the same old thing, 14 hours a week or whatever. Burnout. So you got to be careful. As you can see, it's a long haul. Yeah. I thought you might be interested in that. Okay, so what do we do? Well, go get Google Drive, get a folder to hold your projection. Do this spreadsheet in that folder. Drive is the whole thing. It's got all this stuff. Then you put folders in it. And then you put sheets into the spread, an instance of sheets in there. Set up the initial, starting at the summary, just set this up. Those are generally the pages you'll want to end up with at the end. Summary is also the dashboard, is just added at the bottom. Then you put subheadings as appropriate. How far do you want to break it down? I would include a docs page for every one of these, the docs being a Word. And just so I could record, I did this while I was making this up, record the assumptions because you can't remember. I have CRS. Ever hear of that? Can't remember shit. I actually had juvenile onset CRS. So my case, it didn't come at age, just as there. Yeah, so I have to write all this stuff down. Like, what did I do there? Okay, and then start a notebook, a physical file. Keep records of all this stuff because it's a lot of stuff and you'll forget. You just will. Then get to work. Really good to get a mentor. As Liliana said, we're free, and some people say you get what you pay for, but I don't know. Anyway, this is an awful good thing to have a mentor that's done it before, because it is a little. Nothing's hard. It's just a lot of it. It is complex, not complicated. The other thing that you want to do is iterate, go around the loop. You've got revenue and costs and your marketing plan and your goal and your value proposition, and just go around that loop until you're happy with it. That's what it's for. Just keep going around and around and around. So for startups, we say you can do it until you're happy, or you convince yourself it won't work, and this is the time to find out. Seriously. You know, but you don't spend a lot of money and lose it and get all sad and depressed. And yeah, I mean, it makes you sad, but not as sad as going out of business would. Okay. That's it. Thanks. And I really apologize for those restrooms being locked in. So sorry. Okay. Could you hand out those little, they're on the other side there. And if you'll just put your email address on it, on the other one, yeah, that one. There should be,
Yeah, thank you very much.
yeah, thank you. So
Good information.
Yeah.
the,
How do we reach you?
Now that I'm serious.
oh, okay, if you want to reach me, yeah, just put your email address. I'll send you the slide deck in PDF form and a copy of the spreadsheet.
Great. What was the title of our course again?
Financial projection, I'll do it.
Thank you.
I'll give you
Thank
a
you.
card here.
Thank you very much.
I'm going to be gone for the rest of the month to Deep Dark,
so much.
Oklahoma, but I'll be watching email, so. Excuse me?
Thank you. I'm too much of a technology person. I prefer it. Thank you very much.
Liliana's better at this than I am, though, so. Right quick, I'll show you, this is the live spreadsheet. That's the assumptions, startup expenses, all of this is live. Okay. Yeah, so you can, like I said, just remember, please, to make a copy of it. This was the thing that excuse me, this page we didn't go over in the workshop. This is the page that I set up to make the graphs from.
That one.
Uh-huh.
the assumptions?
Yeah. No, this was just for to make that graph I showed. Yeah. I did go over that because I didn't.
Guys going up or going down?
Yeah. Where the guys. Yeah, but this, all of these are, but you can change these and see what happens in the others. What a good investment when you start doing this stuff is another monitor. You get a pretty good one for like $120, something like that. And to be able to put your spreadsheet up so you can see one, you know, you can see how it changes when I've done it so much, I probably couldn't do anything without two monitors, but it is a good investment.